We have some fives in there. We have a few threes, and the CNBC rapid update, which is the median of 10 tracking forecasts on the street, running at 4.2%. That's a really strong number. You can see that by looking at our first chart, which shows that we've been running at threes, which is also pretty good, by the way. There's an upward shift there. We came back down in the first quarter to 2%. And what we did there is put the four-quarter average. What we've shown is that that four-quarter average is the best way to know where the economy is, because all these numbers over a 5-year period will be revised. But the four-quarter average is the least revised of the numbers. So it shows that you take everything with a grain of salt. Now, let's take a look at who is where. And what you find is that Melissa is exactly correct. Barclays, 5.2%. Morgan Stanley, not far behind, 4.7%. There's the much-followed Atlanta Fed at 4.5%. Deutsche Bank and Chris Rupke at MUFG at the bottom, which is remarkable in and of itself, if the bottom is 3.8%. Now, let's take a look at the next chart we want to look at, which is that this is not the first time this has happened. And also, our viewers are smart enough to know that what we're talking about is the quarterly growth rate annualized. So we're not saying it's a full year. So nobody said that a 4% or a 5% number couldn't be achieved on a quarterly basis. The question for investors is whether or not we've permanently upwardly shifted the economic growth. So let's take a look at the components now. And what I'm using here is Action Economics breakdown of their forecast. They're at 4.1%. And here's how they get there. Everybody has their own sort of secret sauce on this. Consumer, that is strong. Probably some of the tax cut, better wages, a lot of employment. Moving on to the right, business investment, they're down from the prior quarter, which is interesting to me. A lot of other folks are up, so that's a number that's going to be a big swing number. Housing is the only negative in there, and a lot of people are either zero or a little bit positive, but housing is the one weakness that we've seen there. And then you get government, which you know they're spending like it's going crazy. That's going to help GDP. Trade is going to help, and inventories are going to help. And one of the questions on the street is the extent to which both the trade and inventory numbers might be helped a bit by the tariff situation. Did people export a lot ahead of the tariffs and then bring some stuff in? Those things should work in opposition, but right now, so if I could point out the two parts that are probably not sustainable about current growth, it's the trade and inventory numbers.
Forward,
right, and also a little bit of a snapback from the first quarter, which was weak. Over at Pantheon, they say the strength of the second quarter will be cited as evidence that the tax cuts are working, though it's hardly a great revelation that if you borrow enough money from your grandchildren and throw it all at the economy at once, growth will pick up. I think there's more to it than that. What I also know is that when we talk to Kevin Hassett, he has a theory of the case, which is that they're going to change the DNA of the economy. They're going to lower taxes, create more capital investment, boost productivity, and then that will increase wages and have an upward shift in potential GDP.
Okay, different question.
Let me just finish the thought. That could be the case. The point is that over a 6-month period, it's almost impossible for that to happen. So it's a little hard for me to understand or to buy the idea that what we're seeing right now is tax cuts. Right. That could be in our future, and hopefully it is.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.